All right, everyone. Thank you again for joining. We're going to get going, and we'll have some folks that will continue to join us. And we thank you for taking time out to join us today. And so on behalf of the Prudent Speculator and California Kovitz team, I want to welcome you to our 2024 Stock Market Outlook presentation. We're extremely grateful that you've taken time out of your day to join us. I'm your host, Jason Clark. And our presenter today is Editor-in-Chief and Senior Portfolio Manager, John Buckingham. I've had the honor of working alongside John for 17 years now, after I served in the United States Navy and worked in the investment industry, trading corporate bonds and conducting institutional equity research. John has been with the Prudent Speculator for 37 years, working alongside founder Al Frank from 1987 to 2002. John has led our portfolio management team since the early 1990s and has been editor-in-chief of TPS for more than 2 decades. Before I turn the presentation over to John, I want to mention that our team does more than just stock research and creating content for the Prudent Speculator newsletter. We also offer asset management and holistic wealth management services for a number of private clients. Our process begins with comprehensive financial planning, and from those outcomes of the financial planning, our clients' investment allocations not only include our broadly diversified value equity strategies, but also may include taxable and tax-free fixed income, specialty strategies like hedged equity and cash to equity, and a potential wide array of alternative investment strategies for those that are accredited investors. Those strategies may include private real estate strategies, private equity, and other strategic opportunities. If you'd like to find out more information about our private wealth strategies and services, don't hesitate to reach out to me directly or reach out to our team. Another note, after John finishes his presentation, and depending on the amount of time we have left, we'll have a short question and answer session. You can submit questions using the Q&A tool at the bottom of your Zoom window. And with that, I'm going to turn it over to John.
Well, thank you, Jason, and thanks everybody for giving us a little bit of your time today. As most are aware, I've been here for quite a while. Believe it or not, I started in 1987, going to work for the great Al Frank. I know we have many long-term subscribers who might be tuned in today, and many of them may have actually known Al. Obviously, Al, it's been a long time since Al passed. Believe it or not, it's been 21 years. And so I had the good fortune of finding a profession where my occupation became my avocation. And it was really something I was interested in. I started as a senior in college, worked at the foot of Al Frank for quite some time, and worked my way up the totem pole, wrote for the newsletter, became portfolio manager, director of research. The slides I show on the screen are meant to illustrate that I've been doing this a long time. You can see my level of hair has probably become less over the years. But essentially, we've been saying the same thing over and over, really since Al Frank started the newsletter in 1977. And that is, you buy a broadly diversified portfolio of undervalued stocks, and you hold them for their long-term appreciation potential. Now, that doesn't mean that you're not tweaking the portfolio. Stocks become undervalued and fairly valued and even overvalued over time. But the philosophy, the strategy has always been a value-oriented approach. And so we'll talk a little bit about the approach as we go forward. One of my favorite quotes from Al is this one: "Successful speculating is more a matter of character than mathematics, analysis, or luck." It's not rocket science, what we do. The key to investment success is to be patient and to allow the economy to grow over time, to allow the companies in which you're invested to become more valuable over time, despite all of the fluctuations that may occur in the short run. So the presentation today will consist of essentially 3 main areas. One I call the rear view mirror, which is looking back at 2023. Then we'll look ahead to 2024 and make the case for value. And then if you're good enough to stick with us, I will talk a little bit about some of the investment themes we see for the year with specific stocks that fit those themes. So there'll be 14 stocks that we kind of highlight toward the end of the presentation. So looking backwards at 2023. One of the things, of course, we endured in 2023 was tremendous volatility in stocks. We had a banking system near meltdown in the first quarter. We had a lot of things that many folks might have been deeply concerned about, and yet the stock market in general did extraordinarily well. Obviously, growth stocks did much better than value last year, but there were double-digit percentage returns for the value indexes last year. So it was a good year. And one of the mantras that we live by is this quote from Lao Tzu, which is, if you do not change direction, you may end up where you are heading. So a lot of what we do is to try to keep investors on the path to achieving their long-term investment success. The challenge, of course, is you're always bombarded by headlines, talking heads on CNBC or elsewhere, trying to convince you that doom is just around the corner. Bad news, it seems, sells more newspapers than good news. And there's always a propensity of the media to emphasize the disconcerting things. So, for example, if we think about last year, one of the things we heard was, don't fight the Fed. If the Federal Reserve is raising interest rates, you don't want to be in stocks. Well, believe it or not, the Fed funds rate last year rose considerably, and yet equities had a terrific year. So when you hear the statements that are made, sometimes by seemingly very well-credentialed people, you always want to kind of take a step back and look at maybe what has actually happened historically when events like this have occurred in the past. So we publish all sorts of information, as readers know, in the newsletter, all sorts of facts and figures. And one of them is, what happens when the Fed raises interest rates? Well, historically, and I don't have that particular chart in this presentation, but historically, stocks have done fine whether the Fed is raising rates or lowering rates. They've done fine on average. That doesn't mean all the time they do well, but on average, stocks have done well. So the odds are in your favor. Again, we had, very disconcerting events occur in the fourth quarter, which was the, Hamas-Israeli situation. Not a good thing, of course, very concerning. And yet stocks had a fantastic Q4. So, we like to look back at things that have happened in the past and what has transpired since. And so this particular slide, I'm showing the Arab-Israeli conflicts. There's been all sorts of things going all the way back to independence for Israel in 1947. And yet, while short-term events could be met with selling in the equity markets, longer term, I don't want to say these things don't matter, because of course it does matter on a human level or personal level, but on a stock market level, generally speaking, equities have managed to overcome pretty much everything. And of course, we still have the Ukraine-Russia situation going on. And so we've looked again back at important dates in Russia-US history. There have been some very frightening events, Cuban Missile Crisis, which, I was not even I wasn't alive in 1962. I was born in 1965. But obviously that was very frightening. But yet you see how stocks have performed over the long term. We've managed to overcome every single event, on this particular, table. So again, there's always going to be bad things that happen, always things to worry about. And this particular slide is showing, all of the very disconcerting events throughout history going back to the 1940s, including 9/11, the crash of '87, all sorts of things that you might think at the time were, things that might cause you to want to exit the stock market. But the moral of the story is the secret to success in stocks is not to get scared out of them. So we try to show data because, again, the numbers are the numbers. Emotions, of course, can drive investment decisions, and we try to keep that out of the equation as best we can. That doesn't mean that stocks don't go up and down. What I'm showing in this slide is the advancing markets, declining markets. So if you look at 5% pullbacks, they happen on average 3 times a year. 10% corrections happen every 11 months or so. And then if you go up to 20% bear markets, they happen every 2.8 years. And yet, despite all of that downside volatility, those who stuck with stocks, as you can see on the right side of this table, have done very well. The value stocks have averaged over 13% a year in terms of returns since we started the newsletter in 1977. That's the value stocks index as compiled by Professors Fama and French. And you're free to go onto their website, just Google, Ken French, data, and you will have access to all the information. Download it, put it in a spreadsheet. You can crunch your own numbers and see the same results. Dividend paying stocks have outperformed non-dividend paying stocks. Value has outperformed growth over the long term. And then you can see how bonds and ultimately inflation has been over the period of time since we've launched our newsletter in 1977. So volatility is a normal part of the process. Unfortunately, many investors can't deal with the volatility on an emotional level, and they tend to zig when they should zag. They buy high and sell low. And history shows, and the data has been compiled, that the average mutual fund investor is a pretty awful market timer. If you see the 30-year returns on funds had been almost 300 basis points, 3 percentage points lower than the S&P 500. And if you think equity investors are awful, look at the bond. The average fixed income fund investor over 30 years has lost money. Well, over 20 years has lost money. Over 10 years has lost money. Every period through the end of 2022, fixed income investors had lost money. I mean, it's crazy how bad the market timing is, and the bond market is even worse. As you can see, the results there for the average, the U.S. aggregate bond index return has been positive. Well, obviously not the 1 in 3 years. But the moral of the story is that most investors are lousy market timers. And as Benjamin Graham says, the investor's chief problem and even his worst enemy is likely to be himself. And again, it's that emotional decision that folks make. So 2023, a perfect example, tremendous amount of bad news or disconcerting news. Again, the banking situation, Russia, Ukraine, the Fed raising interest rates, and the Arab-Israeli conflict. All of these things are very disconcerting, but yet stocks manage to gain ground. So as we think about 2024, we have to keep in mind what happened in 2023. Again, growth stocks outperformed value stocks by a wide margin. Value did quite nicely, far better than most would have expected at the start of the year. And so that, in my mind, gives value a little bit of a tailwind as we go into 2024. The valuation gap, and I'll talk about that a little bit later, the valuation gap between value stocks and growth stocks is very wide today. And so value stocks are undervalued today relative to where they historically trade. But let's look at some data, some numbers. Again, I always like to put quotations in here. Al Frank was a great user of quotes. This particular one, fear cannot be banished, but it can be calm and without panic. It can be mitigated by reason and evaluation. I think that's really important because it helps to keep you on an even keel. You hear something and it sounds scary, and maybe I should do something with my portfolio. But then if you actually look at the historical evidence, it hopefully, and we publish this stuff every week, hopefully will keep you calm and again, keep you on the path to your long-term objectives. Because most investors in the stock market are not investing for the next day or the next week. Certainly if you're a follower of ours, you're not a day trader. You're investing for the long term. So what happens on a short-term basis is really irrelevant to where you're headed over the 3 to 5 to 10 to 15-year period. And when you look at long-term returns, value stocks, if you go all the way back to 1926, value has outperformed growth, again, by a very wide margin, 13.2% to 9.6%. And through the miracle of compounding, you can see that money can grow dramatically. You don't have to make a tremendous return, but let's say you make a 10% return. through the rule of 72, your money will double in 7 years and then double again 7 more years. So after 14 years, you don't have 3x, you have 4x, and then double again. And so many investors, most investors, I would argue, have a long-term time horizon, 10, 15 years at least. And they certainly can ride through the inevitable ups and downs, as are visible on this chart. There have been many periods where stocks have gone south. And we saw that even in 2022, where stocks had negative returns. We saw it, heck, in 2020 during the pandemic, the throes of the pandemic, when the average stock was down 40%, essentially on March 23rd, down 40% for the year in 2020. So again, the key to success, and we publish statistics on what has happened previously when we've had health scares and pandemics. And again, we hope that those special reports we put out allowed investors to stay the course and not panic and bail out of stocks. Because remember, there wasn't a cure, or I shouldn't even say a cure, there wasn't a vaccine until November of 2020. And of course, we can debate the value of the vaccine or the efficiency of the vaccine, but really there wasn't any, COVID hasn't gone away. If we go back to even HIV, for example, that was first sort of uncovered in the early 80s. That hasn't gone away either, but it has not had a long-term impact on the stock market in terms of, returns for investors. So I mentioned earlier that value is cheap relative to where it has traded historically. And this chart is showing a PE ratio for the Russell 3000 value index relative to its average or its mean. And you can see we're a little below average on the PE ratio for value. And the darker blue line is growth. So we're well above average for growth. So on a valuation basis, value is attractive, especially relative to growth, and even attractive relative to where it's traded historically. And again, this chart only goes back to 1995 and the launch of the Russell indexes. But I think you can get the idea that the fact that growth has done really well in recent times, and we own many growth stocks as well, so we're not complaining that many of those have done well, that on average, you would probably want to be focusing on value priced stocks today, simply because the laws of mean reversion, if you will, we might expect the PE to contract a little bit back down to that mean line for growth, whereas value is certainly a better place to be from my perspective in terms of overall valuation. Also, as we think about interest rates, that is a key component to the investment equation. You always have a choice. Do you want to invest in stocks, or do you want to invest in bonds or alternatives or so forth? So the interest rate environment is very important. But we can see today that value stocks, again, are still very attractively priced vis-a-vis interest rates. So the earnings yield, which is the inverse of the PE ratio, is still at a much higher level than the quote unquote risk-free rate. And for us, we're using the 10-year US Treasury as the risk-free rate. And even the dividend yield on value stocks is about average going back to 1995 as well, from where it historically has been. So I really think that from a valuation perspective, you want to be emphasizing value stocks. And again, the historical odds favor value as well. Now, we also, think about where we are, in terms of the corporate profit picture, because the chart I just had up was showing the trailing PE ratio for the value indexes. Well, over time, earnings are likely to grow, and we think that the earnings in 2024 are likely to be substantially greater than in 2023. Now, I'm showing you the S&P 500, but the same would apply for value stocks as well. And so when you're going to get the E growing, you could have the P grow as well and still be at the same PE ratio. So again, if you look back through market history, the only times we really had sustained market declines, and of course they didn't last, but we had sustained market declines, is when you have a profit recession, when corporate profits actually decline, which is what we're showing on the chart on the left. And so we're just not seeing the likelihood at this point anyways for a profit recession. Now, that doesn't mean that we're saying there won't be any kind of a recession economically speaking, but the US GDP has been very strong, 4.9% in Q3. The current estimate for Q4 of 2023 is 2.5%. Now, going forward, of course, the Federal Reserve and most economists are thinking that we'll have a very low real, meaning inflation-adjusted GDP growth rate in 2024, something on the order of maybe 1.5%. But even if we have that kind of a growth rate, that's still going to be supportive of corporate profits. Because one of the things that I seem to be one of the few that likes to ever talk about is that usually when you talk about GDP growth, you're talking about it on an inflation-adjusted basis. But yet corporate profits and stock prices are not valued or recorded in inflation-adjusted numbers. They're in actual or nominal numbers. And the chart I have up on the screen now shows in the blue shaded area, US GDP has continued to grow on a nominal basis to very large number, and is likely to continue to grow even further as we go forward. So the economy grows over time, corporations become more valuable over time, and if you have the courage and conviction to stick with stocks through the thick and thin, you should be benefiting and doing just fine over time, as long as you have decent stock selection. There's the 2.5% GDP growth forecast we're seeing at present. And keep in mind also that last year, many investors or many economists were expecting a recession. We just had last week the December jobs report. Payrolls came in a little better than expected. And of course, we're sort of in a perverse world these days where we don't want the economy to be too strong, because then the Federal Reserve may not be inclined to lower interest rates. And obviously, we don't want it to be too weak, because then we're headed toward recession. But I'm not suggesting that we're still in the Goldilocks environment, not too hot, not too cold. But I think the economy is going to do okay in 2024. If I had to bet, will there be a recession or not? It might be a coin flip, 50-50 chance. But if there is a recession, I think it would be very mild. And speaking of the Federal Reserve, when I put this together, which was over the weekend or Friday, the Fed is likely to lower interest rates this year. We're at a 5.5% Fed funds rate, and that's likely to decline. The odds as of last Friday were that we might end the year with a 4% or 3.95% Fed funds rate. So that's quite a few interest rate cuts that are expected for the year, which, again, I'm not saying that stocks need lower interest rates to do well, but it certainly doesn't hurt. And again, we have data that shows that even a increase in the 10-year Treasury yield or the Fed funds rate is still fine on average especially for value stocks. So the idea is that this year we're likely to see lower interest rates, at least from the Federal Reserve and their benchmark borrowing rate. We're likely to see a decent economy, not a great one, and not a one that falls deep into recession. And we're likely to see corporate profits continue to grow. So in my mind, I think that's a positive backdrop for stocks. Now, when we talk about the Federal Reserve, their concern, of course, is inflation. And we've seen inflation come down considerably this year. And, it peaked at, 9 some odd percent, 2022. And so we've had a big drop in inflation. So inflation's heading in the right direction, which again allows the Fed to become less tight and more accommodative, and potentially lower interest rates throughout the year. Here's, speaking of inflation, just again to give you some data. We looked at what happens when inflation is rising, what happens when it's falling, what happens if inflation is high or inflation is low. And the returns on stocks on average have been just fine. So there's no reason, if you're worried about inflation, to be selling stocks. The historical data does not support such a decision. If anything, higher inflation, believe it or not, has been a positive for value, even more of a value, positive for value over growth. And so it's another reason you'd want to be gravitating toward value, is that if you are worried about inflation, or even if you think inflation is going to fall, as the betting odds suggest, value has done just fine, whether inflation is high, low, rising, or falling. And one of the other interesting things that data will show you is that the last time the Federal Reserve had to fight inflation at this kind of level was back in the late 70s, early 80s, in the Volcker Fed, when the interest rates were extraordinarily high, the rate of inflation was extraordinarily high, and the Fed did all it could to bring down inflation. Well, in that process, there were two recessions that were caused. You can blame the Fed for it. Two recessions, but yet if you look at the Volcker years, and that's what the table shows, value stocks during those Volcker years, and a time when the Fed was, valiantly fighting inflation, averaged a 24.7% rate of return. That's per year, not total over the whole time frame, but per year. So we can only hope that this inflation fight that Jerome Powell has had to undertake will end half as good as the Volcker Fed ended. But we've seen stories, heard talking heads say, "Oh my gosh, inflation is so awful; it's the worst it's been since the 1980s." And somehow that's bad for stocks. Well, here's the data. It wasn't bad for stocks back then. So again, I still think you can try to stay rational and on track to achieving your objectives by paying attention to what has happened historically. History never repeats, but it often rhymes, is the slogan. And even today, the economists don't know if we're going to have a recession. The odds are roughly 50-50 as calculated by Bloomberg. So I can't tell you that we'll escape recession in 2024. But what I can say is that even if we have a recession, and there have been recessions before, there will be recessions again, but history shows that you have to have phenomenal market timing to have somehow managed to avoid a modest loss during the recession, and then get back in. See, that's the challenge, right? It's easy to be quote unquote right once, very hard to be right twice. And so if you manage to avoid the recessions historically, looking at value stocks, the 1 year after the recession has ended, the average return had been 41%. So you run the risk of being out of the market and missing that 41% return, because whatever took you out of the market is likely to keep you out of the market, because it's not as if they ring a bell at the market bottom, tell you, okay, it's time to buy. And I go back to March of 2009 at the bottom of the financial crisis. There's a quote I like to show from Warren Buffett, who essentially said that the economy had fallen off a cliff. And for Buffett, of course, who's usually an optimist, that was a pretty strong statement. Well, that was on March 9th of 2009. That appeared in the New York Times, and that was the exact bottom of the market. So if you ever see Warren Buffett being scared or nervous about things, that's usually a time that you might want to be thinking about buying. And then we also look at what has happened in the 4 years of the presidency. Historically speaking, the third and fourth years have been the best. The first and second years have been strong, but not as good. Obviously, the third year was very good. Value really has done well relative to growth in presidential fourth years. Now, every fourth year is different, and I know it's a small sample size. But again, another factor favoring value stocks would also be the calendar. So the secret to making money in stocks is not to get scared out of them, has long been our mantra. And you can do that, again, by analyzing the data. We publish it for you, But again, much of what is said on the airwaves just isn't true, or is designed to scare you or cause you to do something that ultimately might jeopardize your long-term financial health. So with that as a backdrop, again, I think the valuations favor value, the calendar favors value, lower interest rates have favored value, a more friendly Federal Reserve has favored value, economy that's continuing to grow and corporate profits that have continuing to grow have also been supportive of value stocks. So people ask me, well, what's your projection for the year? I always start my projections with the average, 13.7% or 0.6% is what value stocks have done over time. The fact that Q4 was so strong might cause me to temper that outlook a little bit. But again, historically, double-digit returns on stocks are the norm on average. And I think that there's no reason why we can't see that kind of return for 2024. Again, no guarantee, no, past performance not indicative of future performance. And I'm not clairvoyant or somehow have a crystal ball that suggests that. But anybody who argues that, we're going to have a single-digit return year or lower, meaning a loss, is super bearish, because you're going against the historical odds. The stock market, some view it as a casino. It's a casino that is stacked in your favor. You are the casino, because over time stocks have appreciated, and if you stick with them, you're likely to get those rewards. It's not as if the market is out to get you and somehow you're going to lose money. Yes, if you're a lousy stock picker and buy overvalued stocks and panic and sell them at the wrong time, you certainly can lose money. But even when I showed that slide of how fund investors had done, they had actually still made money. They just didn't make what they could have made if they, generally speaking, stayed the course and didn't jump from one elevator to another elevator. So that's kind of our backdrop of where we think things will go. And obviously, I'm partial to value stocks, and those are inexpensively priced companies, generally speaking, low PE ratio, low price to sales ratios, low price to book value ratios. And there are still a lot of bargains out there, because remember last year, the gains of the S&P 500 were really magnified or almost accounted for by a handful of stocks, maybe the Magnificent Seven or maybe the top 9 or 10. But the average stock didn't have a phenomenal year. It had a good year. The average stock in the Russell 3000 index was up about 13%. And in the Russell 3000 value index was up about 12%. So last year was more of an average year for value. So I don't see any reason why 2024 can't be an average year or even a little better for value. And we have lots of different investment themes that we would incorporate into our analytics and our thinking. But for purposes of this presentation, we wanted to highlight 7 of those investment themes. And again, our approach is to buy a broadly diversified portfolio. So I'm going to show you 2 stocks for each theme. In my own portfolio, I have over 80 stocks. I'd like to see anybody who follows our approach have at least 30 to 35 stocks, because we never know which company is going to be, the next home run, or which is going to be the next, disaster. And our experience over time has been that our winners have won more than our losers have lost. And so roughly 2/3 of our stocks have proven to be profitable and 1/3 haven't. And I know you could say, well, just get rid of the 1/3 and then you do even better. Of course, the same analytics that got us to the 2/3 winners also got us to the 1/3 losers. So we like our approach. We like the work we do. We feel we do extensive quantitative research looking at historical data. We also do qualitative research looking at the prospects of the companies in which we're investing. And then we further look at prospective valuations. Where do we think this stock can trade over the next 3 to 5 years? Where are earnings likely to go? And what kind of multiple are people willing to pay for those earnings? Those are all the important factors for us. And then, is the stock today trading at a significant enough discount to what we think it's worth? If it is, then we're buyers. If it's not, then we'd be sellers. And as it approaches that fair value, we might trim a portion of a holding, or we might sell it even outright, because every stock in our portfolio is fighting for its spot. There's always another name that we might end up liking better. And so we'll often swap out of stock A into stock B. So all that's my way of saying that, yes, these are 14 names that I like today. And I think that investors who believe in value should be considering them. But they're not the only 14 stocks that we like. So another quote here from Warren Buffett: whether we're talking about socks or stocks, I like to buy quality merchandise when it's marked down. And again, that's our approach. We're trying to buy things that may be cyclically out of favor, may have be in a sector that investors decide for whatever reason they're not overly thrilled with today, or just may be at a stock price that we think is far too low, and that there might be a valuation expansion. It might be trading at 9 times earnings, and we think it should trade at 12 times earnings. And those earnings are likely to grow, so we might get growth of the multiple as well as growth on the earnings side. So the first, oops, sorry for the touchy slide. The first theme, if you will, stems from what I talked about earlier with the financial situation, the banking crisis. Babies were thrown out with the bathwater during the upheaval that we had. Yes, Silicon Valley went under, Signature Bank went under, First Republic went under. We weren't invested in those, but many of the stocks in which we were invested got tarred with the same brush. So like a PNC Financial, which was a quality regional bank with a big dividend yield, we think that's a name investors should be looking at. Again, a baby thrown out with the bathwater. And then also a new recommendation recently for us is PayPal, which is a financial technology company. And most of us have probably used it, or Venmo. But it's come down considerably in price from the pandemic era highs. I mean, it's down 80% from the highs, and today trading around 12 times earnings or so. So opportunities exist out there. You just don't need to be focused on the mega cap stocks. Second theme, which is I call healthcare is temporarily in the sick bay for a variety of reasons: patent expirations, worries about price controls, sometimes drugs not getting the approval that maybe investors were hoping for. A lot of the big pharmaceutical companies are trading at very inexpensive multiples of earnings, single digit in the case of Bristol Myers, with a very rich dividend yield over 4.5%. And again, I think that demographic trends, we're living longer, we require greater access to healthcare. These are factors that support the healthcare sector in general. CVS is on there. They obviously own the pharmacies and have managed care and pharmacy benefit management. And CVS is a company that's always traded at a low multiple of earnings, but we think it deserves a higher PE. And oh, by the way, we think their earnings are going to grow nicely over the next 3 to 5 years. So even if we don't get a multiple expansion, we still see CVS as a company that can grow. And again, just because we're value investors doesn't mean we don't want our companies to grow. And I think that CVS will actually grow. Electric cars will arrive eventually. We've certainly seen a lot of interest in investors in the next big thing. For every Tesla, there's been a Lordstown Motor or a Rivian, or companies that have not rewarded investors. So, our view is that we'd rather invest in profitable companies, not startups, and not companies that are losing money and hope to one day make money. We'd rather invest in profitable companies that might benefit from the interest in electric vehicles. One of those companies is Albemarle, which is a specialty chemicals maker. Primarily lithium is what's been driving their revenue and earnings here of late. Of course, lithium is used in batteries for electric vehicles. And Albemarle has been a stock that has been a home run for us. We trimmed and it's come down considerably, so much so that we've actually been buying it again. And so somebody who wants EV exposure, I'd rather invest in what I call the picks and shovels, the suppliers to the EV makers, rather than try to pick necessarily the EV winner out of all of the, as I said, for every Tesla, there are many companies that didn't make it. Now, General Motors is on this list, and of course, they're an EV maker as well, but they're super profitable. So they're able to fund all of their R&D via tremendous cash flow. And they had so much cash flow, they bought back 20% of the stock here recently. So, General Motors is a name that I think is worth a far greater price tag than where it's trading today. And again, they have the money to build out their EV and their autonomous auto operations. Now, everybody has heard that we're all trying to move toward cleaner environment, and the electric vehicles are sort of being mandated, even here in California, of course, are being mandated to try to get gas guzzlers off the road. Well, while some may target a 2030 or 2040 deadline, if you will, for no more combustion engine cars, it's just going to take a long time to get there. And we also have to keep in mind that a lot of fuel is not just used in automobiles. It's used in other transportation and heating and all sorts of things. So we still think, we call it dinosaur juice for portfolios, is something that will benefit investors by focusing on companies that have old time, if you will, oil and gas operations, but also have the ability to invest in the case of Chevron, in the next generation, technologies. So you use the cash flow from the dinosaur juice, if you will, to be able to fund cleaner burning businesses. And Devon Energy also, these are stocks trading at very reasonable multiples with big dividend yields. And I just think they've been unfairly punished because of worries that somehow we're not going to be using fossil fuels going forward. It's going to be a long time before fossil fuels will ever go the way of the dinosaurs, we like to joke. More, I guess, I don't want to say sexy, but these days AI, artificial intelligence, has driven a lot of investors into names like NVIDIA. And we benefited because we own a lot of technology in our portfolios. So we've had some success because of AI trends. Now, we don't own NVIDIA. We did own it way back when, and made our 300 or 400% and thought that was good enough. And of course, missed out on the next 1,000%. But such is life. And we stayed true to our philosophy of buying undervalued stocks and selling when they were fairly valued. But there are still what we call intelligent ways to play AI. And again, it kind of comes back to that picks and shovels approach. Companies that are making the tools that you might need for being able to benefit corporations to use AI. So semiconductors obviously is a building block of all technology. So Kulicke & Soffa is a semiconductor capital equipment maker that hasn't had a massive run-up, unlike many of the others that have. We own Lam Research, and then in the semiconductor space, we own Broadcom. So we've owned many companies that have done very well. So I'd rather, if I'm talking about something new, I might be focusing on a smaller name like Kulicke & Soffa. And then we have Digital Realty, which is a data center REIT. We need more computing power to support AI and all the offshoots thereof. And Digital Realty is a data center REIT with a nice dividend yield. And again, we think a tailwind from the upgrading of all of the computers that are going to be needed as we go forward over the next decade or so. And then small company, big potential. So small cap stocks lagged last year. Small cap stocks are very attractively priced relative to their history and certainly relative to large caps. So a couple of names on here. Fresh Del Monte was a recent recommendation of ours. Food producer, bananas, pineapples, and so forth. Again, reasonable valuation, 11 times earnings or so, with a 2.5% dividend yield. And then a little company called World Connect, WKC, which is a fuel supplier to boats and planes and tankers and all those sorts of things, providing the fuel and logistics. Again, another reasonably priced company that we think has potential to get a much higher valuation as we go forward. And then last, but not least, is enhancing exposure by leveraging the power of the world. So international markets have been weak. Obviously, the economy in Europe has been soft, and we think there's opportunity for investing in the world, but doing so with U.S. Traded stocks. And a company like Manpower Group, which is a staffing services company, derives the bulk of their revenues from Europe. We believe European economy will get back to growth over the intermediate to long term. And this is the time that you want to be buying Manpower. You want to buy it when things aren't great. And even though things aren't great, they're still very profitable, still delivering a handsome dividend yield. So again, trying to buy low and sell high. And then Nutrien, which is a potash fertilizer maker and agricultural service provider. It's a Canadian company. Nutrien is trading at a very low valuation. We like the global agricultural story over the long term. People need to eat. And as people have better diets and incorporate protein into their diets, that requires more crop nutrient to feed the animals. And so we think Nutrien is a very interesting name, again, as we think about the global economy. So, people will ask, okay, so you're a value manager. Well, talk to me about the metrics associated with your account, because, value stocks today are trading, depending on the index you look at, you might, value the Russell 3000 value index is trading at 17 times forward earnings. Some will say that's not all that cheap relative to history. And I would agree, it's almost, to average, but we're not investing in the index. We're buying individual names. So you can see in this chart, the multiples on our stocks, our portfolios, our newsletter portfolio, TPS portfolio, it's 13.6 times earnings on a forward basis. And you go all the way down to the small cap portfolio we have, which is 11 times earnings. And then you go all the way to the right and you see those dividend yields, 2.7 to 3.1%. So we feel we have stocks that are more attractively valued than the indexes on the value side and have higher yields. And so we really very much like our portfolios for the long term and even for the short term, again, as we're getting a decent sized yield off of our strategies. So, I mentioned that, buying undervalued stocks is key. Trying to hold them through thick and thin is super important, as lots of headlines will cross your feeds, if you will. But we also like to look at, again, that data. And if you look at history and you see if you hold stocks, value stocks for 1 month, the odds that you're actually going to beat the risk-free rate, not just make money, but beat the risk-free rate, are roughly 63%. You hold for 1 month, but if you hold for 6 months, it jumps to 70%. 1 year, 73, 5 years, 90%. So again, the longer you hold, the less chance of loss or the less chance of a negative return. So patience is super critical for everything that we do. For compliance reasons, I have to show you all of our recommendations here. And I know you just wrote them all down and read them, but if you're a newsletter subscriber, you know all of these names. And then I have my last thing, I have my more compliance info. Again, our strategy is designed for long-term oriented investors. We're disciplined and patient, and we think we sleep very well at night with the valuations of our stocks. So with that, I'll turn it back over to Jason, and hopefully we'll have some time for Q&A.
Thanks, John. We got some great questions that came in, and we will kind of go through them. You'll have to excuse me. I want to read some of them so that I'm fairly accurate. John, first question to you. With the presidential election fast approaching, should I be making any changes to my portfolio?
Well, I said in the presentation, or showed in the presentation, that the fourth year of the presidency historically has been very favorable for stocks, especially value. So if you were thinking of making changes to your portfolio, it would be to gravitating toward stocks. I know that there's plenty of consternation about the candidates, no matter which side of the aisle you're on. But again, we were worried about Trump in 2016. We were worried about, Biden in 2020, and yet stocks did very well during their administrations, despite some rocky periods along the way. So I wouldn't alter a long-term oriented investment strategy because of the election. At the margin, if you will, I would probably steer more of my money toward value versus growth if I had, growthier stocks in my portfolio.
John, I see you mentioned Apple, Microsoft, and Alphabet in your Where to Invest 2024 report. Aren't these growth stocks? That's the next question for you.
Well, it is an interesting conundrum for us. One of the differences for us and other value managers is that we have a lot of technology exposure. I was a computer science major in college, and Chris Quigley on our team is a whiz, and I'll even say Jason knows his way around a spreadsheet and a computer and all those sorts of things. So we have more tech than maybe the average value investor. The difference perhaps is that we bought our tech when it was very attractively priced. We don't discriminate. If a stock still has upside potential, as we think that Apple and Microsoft and Alphabet do, just because it's jumped buckets, if you will, just because it went from being a value stock to a growth stock, doesn't mean that we have to sell it. We also own Meta Platforms, and Meta, believe it or not, is in the Russell 3000 or in the S&P 500 value index, because at the end of last year, and end of 2022, I should say, the stock had been crushed and was trading, at a multiple of 11 or 12 times earnings. It went up 180% last year. So now it might end up in the growth index, but that doesn't mean we have to sell it just because it moved there. So long-winded answer to the question is we bought the stocks when they were value. We still think there's enough upside potential to justify a continued hold. And yes, we've trimmed along the way. And that's part of our strategy, is to reduce risk over time. Apple, if we go back to my own account, my cost basis is about 10 cents. And so we've trimmed it, 7, 8, 9 times. Otherwise, it'd be, we don't half the world, I suppose, if we never sold any. But that was risk mitigation. And I think it's important for investors to keep that in mind, because many investors have huge positions that they've accumulated in things like NVIDIA and Apple and Microsoft. And I think it's prudent to be trimming them and redeploying those dollars into more inexpensively priced stocks along the way.
Thanks, John. In addition to the tech exposure, is there anything else that your brand or our brand of value investing differs from others who follow the value approach?
Well, I would argue that, we have a lower exposure to financial stocks than the value indexes. And it's not that we don't like financials, because again, that was one of our themes, yelling fire in a crowded theater. But we are comfortable, not having 15% or so in financials. We don't feel we need to have 20-something% like the indexes have. And also the value indexes generally have a higher weighting in utility stocks. And we just don't see a whole lot of opportunity in utilities aside from the one that we own. I just bought more of it for myself last week, Pinnacle West Capital. PNW is a ticker symbol there, but we don't see a lot of opportunity in those areas. So we go where the bargains are, and the bargains will tend to congregate in various sectors, and they just don't congregate in some of the areas that maybe value investors might be more inclined to overload.
All right, I'm going to ask you to be brief in this one, because I know you could go on for quite a while. What's the nature of the due diligence you guys do on a particular stock? Can you briefly talk about the quantitative and qualitative research you do? And do you meet with senior management? Why or why not? Sure.
Well, it's hard to be brief on a question like that. But again, our approach is essentially threefold, 3 facets to it. The first is a backward-looking quantitative review where we evaluate 3,000 companies relative to their peers. And then that shapes the next level. So we narrow down the big universe to a much smaller list of names that are worthy of additional research on the qualitative level. So the qualitative piece is let's try to ensure we are not investing in buggy whip makers. Of course, nobody knows what a buggy whip is anymore, but we used to have horses and buggies, so you needed a whip for the horses. Then the automobile replaced that. So if you made whips, you probably went out of business. So we're trying to, not end up with value traps. And so the idea is that you want to evaluate the business, make sure it's viable, make sure its competitive position is sound, make sure that management isn't going to do something stupid, and make sure that they're good stewards of shareholder capital. But then the third piece is to look at, is this stock undervalued relative to where we think it deserves to trade over the next 3 to 5 years? So that's a forward-looking view. And so, when we talk about growth, the growth style of investing, those companies are likely to have higher earnings, over time and grow faster than many of the value price stocks. And yes, you often have to pay a premium for that. And I think for many companies, the premium's too high today. But just because a company is growing its earnings doesn't mean that it can't still be a reasonably priced stock, like Microsoft, like Apple, like Alphabet, like a Meta platform. So we're still willing to own those. You also asked about whether we meet with senior management. No, we do not. We found it's impossible to quantify the quality of management. Some managers are sensational for a period of time, and then cyclical factors do them in. And so we do not meet with management as a rule. If we have a question that we need clarification on, we will certainly contact the companies to get that information. But everything we need is available in the publicly available data. We of course utilize Bloomberg, so we have access to 10Qs, Ks, all the financial filings, holdings of management, all sorts of information. And so we feel very confident about our ability to avoid enough of the value traps, but also to get the things that may have looked like a value trap, but then went on to be, phenomenal returning stocks.
Thanks, John. Number of questions around gold miners like Newmont. Since the end of 2022, gold's up, looks like about 10%, while many of the miners are flat to even down double digits. Any thoughts around the gold miners?
Yeah, that's a dilemma for us. Generally speaking, we don't like gold as an investment vehicle. There's no income, if you will, produced off of gold. Its value is entirely subjective, based on what others are willing to pay for it. And I'm not saying that it doesn't have value, because again, you go back to the BC time, and gold has always been a storehouse of value over time. But it's very difficult to value gold. Now, having said all of that, when you look at the gold miners, and we do own Newmont Mining, NEM, which has a very generous 4% plus dividend yield. The gold miners are the way, if you want to invest in gold, is how I would play it, because you're buying assets in the ground, if you will, at a cheaper price than what gold is trading at today. So they are levered ways to play gold. They should have been up last year. They were not up last year. And I think that will ultimately reverse. And again, if gold becomes I don't want to say it becomes a Bitcoin type investment again, but if gold, explodes in price, I still think the gold miners are going to do even better as we go forward.
All right, well, we're running low on time, so I'm going to ask one more question, and I want to note for others that asked questions and we didn't get to those today, we'll reach out to you directly and get you a response. And then so after this question, I've just got a couple of housekeeping items I need to share with everybody. But John, with a failed Santa Claus rally in the first 5 days of the year being negative for the S&P 500, should I be worried about 2024 in stocks?
Well, that's a good question, because this failed Santa Claus rally, in my mind, is a myth. I guess the last day of the year wasn't very good, but the days before that were fine. December was a fantastic month. And oh, by the way, guess what stocks were up in the first 5 days of 2024? That's right, value stocks. The Russell 3000 value index was higher. So, and now Russell 3000 growth was down and the S&P 500 was down. So I just did a Forbes blog on the topic. If you go to Google me at Forbes, John Buckingham, you'll see the latest blog in all likelihood. But if you buy that argument that first 5 days matter, and statistically we don't think it does, But if you buy that argument, then that's another reason to be gravitating toward value, because value stocks, believe it or not, were up over the first 5 days of the year. And these are the 5 trading days, 4 days last week, 1 day on Monday. And yes, it took a big rally on Monday to get there, but it did. And so value was up the first 5 days. So another reason to be favoring value as we go through 2024.
All right. Thank you, John, for your time and your efforts for today. For everybody else, we want to thank you again for joining us for our 2024 stock market outlook. I want to throw out there that we're currently finishing off a 2024 visual guide to the markets, which will be available in the coming days or week. And there's going to be a number of other special reports and content that we're going to produce for you throughout the year. Additionally, we're going to do more of these webinars, and an upcoming one will focus a bit on financial planning topics, as well as other stock-specific or stock market themes. The full 2024 stock market outlook report with all of the picks, not just the ones that John mentioned today, they're available on the website. If you're an active subscriber or one of our private wealth clients, you can go to the TPS website and access not just the report, but also the slides from today. And then once we get everything together, everyone who is registered for today and attended today will get an email, which will direct you to the full 2024 stock market outlook report, as well as the slides and the recording of this webinar. So once again, on behalf of the Prudent Speculator and the California Kovitz team, we thank you for taking time to join us today. And thanks again, John, for your presentation. And we look forward to hearing from many of you in the future. Goodbye.